Hello everyone and welcome to your Glassnode video report for week 19, 2022. So we have seen a volatile and challenging week this week with the market trading quite substantially lower, really breaking down to the bottom end of our current range off the back of this announcement from the Federal Reserve on further rate hikes. And really this is just another example of how Bitcoin is tethered inside the global market. It is going to respond to these big picture monetary tightening and the way that liquidity is moving through the system. Bitcoin, as it institutionalizes, is increasingly integrated with these things. So we do see these influences from traditional markets, especially at this current time, affecting the Bitcoin price. So we did see this across all markets, but let's really explore what happened this week. So the bulls really are under some degree of pressure, and we have seen some weakness start to appear across a number of different metrics. Now, what I really want to highlight in this particular session is how diverse the range of tools that we have available are. And the reality is that as the Bitcoin market continues to evolve and mature, we are seeing all sorts of dynamics that include on-chain, off-chain, derivatives, investment vehicles like ETFs. We really have to take a very holistic approach when we're trying to analyze and understand what's going on in the Bitcoin market. And that's really what we do in this particular session. We're actually going to look at what happened this week across a number of angles, everything from exchange flows, we're going to look at network profitability, we're going to look at the on-chain side, the Mempool side, ETFs, and we're even going to close out with a very interesting observation on the stablecoin market. So quite a diverse session today, really trying to look at this from different angles, and hopefully you can see how some of these puzzle pieces get put together. As always, please do give us a subscribe and a like. It helps the channel get more people. As I mentioned last week, we hit 51,000 viewers, so subscribers. So thank you very much for everyone who comes back week after week. Let's get started. Okay, so here we are, and we've been talking about this consolidation range for over 3 months. We've been referring to it as both a consolidation range and also a bear flag, and here we are getting some serious downside price action. Now, this week in particular, we actually did see we saw a positive response, and this is not just Bitcoin, this is in the S&P 500 and equities and bonds. We saw a positive response on the Wednesday when the Federal Reserve announced their rate hikes, putting some certainty back into the market that it wouldn't be 0.75%, it would be 0.5%, but the market then reacted on the Thursday with a very, very volatile downside almost across the board. So very, very challenging conditions, and this is not just limited to Bitcoin, this is a global phenomenon. Now, in terms of our accumulation trend, I've got two metrics here. One is the base accumulation trend score, and you can see that we've had a number of weeks of yellow. We have not had the amount of accumulation, particularly that we started to see up here in this consolidation range. Now, remember, just because accumulation is taking place doesn't necessarily mean that the bottom is in. It also doesn't mean that the people who purchase their coins up here are going to sell. It also doesn't mean that they're not going to sell. What we're looking at is information that is constantly changing. A good example of this, we talked about this accumulation up here as it was happening. And what we've now seen is that a lot of those coins that were purchased were then resold back down into this range. And we're now in this realm where we have to see how that actually evolves from this point on. Remember, markets are a process, not a result. We're always taking new information and trying to assess what is likely to happen in either direction. Now, we then have a companion metric. This is actually one that's in the Glassnode engine room at the moment. This actually breaks down the accumulation trend score by wallet cohorts. So these particular bars here, down the bottom is less than 1 BTC, then we have 1 to 10, 10 to 100, all the way up to the greater than 10,000. Now, this excludes our miners and exchanges, so it's trying to capture that investor style behavior. And what we can see is, note how we had a lot of blue, particularly with the shrimp, but during that period of around coming into the start of April, we really had fairly widespread. A lot of these went blue, which is a sign of accumulation. These entities are adding coins to their balance. Well, you can see that over the last 2 weeks in particular, the 10,000 plus entities actually stand out as quite significant distributors at this point in time. And you can see that it's more or less softened across the board, which highlights what we're seeing here in the accumulation score. So it's kind of a big picture slowdown in that accumulation trend. And when you kind of factor in all of the macroeconomic and the liquidity and monetary tightening, it's a challenging environment. Investors are trying to deal with all of these new realities as they happen. So quite challenging market conditions. Now, if we look at our price drawdown from all-time high, we're just shy of 50%. We got down to about 36,000 this week. So we're just shy of that full 50% correction. Sorry, actually, I take that back. We got to 33,800 was our low for this particular week. So we've more or less matched what we had at the start of this correction down here in January. So it is now a significant correction, but note that we're actually not as severe as we've seen at the final phase, or whether it's March 2020, in November 2018, or even back here in 2015. You can see that we get these slightly improving bear markets over time. So again, that doesn't necessarily mean that we have to go down to 85% of a drawdown, but we also have to be prepared in case that does happen. It would be within the realm of what has happened in Bitcoin's past. Now, here's a model that we actually looked at last week, where we looked at the profitability. And you can see that particularly since around 2016 onwards, what we have shown here is the percent supply, percent entities, and percent addresses in profit. Now, note that since 2016, they've all they move in tandem. They've more or less connected. Doesn't mean that they're telling us the exact same thing, but for the most part, we can more or less see a very, very similar trend going on with these metrics. Now, what we spoke about last week is that we were about 72 or 70% for all these metrics profitable, which means that 30% or thereabouts was in a loss. And what we did is we put forward a particular case study where we were trying to say what would happen if we had a deterioration of network profitability in line with some of these previous bears, particularly March 2020 and 2018, some of these more recent and more relevant bear markets. And they got down around the 50, the 60% at the upper end. So we were looking at, we've got 70%. These previous bear markets were at around 50 to 60. What would happen if we had another 10%? What would price need to fall down to get a 10% of the market to move into that kind of pain threshold of being underwater? And what we established is it was somewhere around 33,600. Well, this week we actually got down to 33,800. And what did we see? We actually saw that we moved down into 60%, 62%. So the case study that we looked at last week more or less has happened this week. We've seen it now play out. We did see 10% of the market move into that pain threshold. And now we're at this level where we're at the bottom of this trading range, and we have similar level of financial pain in terms of people who are underwater on their position as we've seen in previous bears. So again, that doesn't also mean that the bottom is in. It also doesn't mean that this correction is over and that we don't have further to go. But we're just trying to use this to roadmap out how severe is this correction? Are we starting to see, maximum pain? Is there further to go? We're just trying to establish these case studies along the way. Now, this oscillator that we have down the bottom here, because all of these move in tandem, I've just taken an average of them just to kind of give us a single indicator. And then I've looked at the percent change, how much it's changed over the last 30 days. So it's like a profitability net position change. So you can see here in March 2020, we got down to minus 35.5%. So that means that within the span of 30 days, 35.5% of the market went from being in the green to holding an unrealized loss and being in the red. So obviously these deeper negative values show a very rapid change in how many people, how much supply, how many addresses have now moved into a loss. Now you can see where we are at the moment. We're at minus 15.5%, which is not significant. It's much, much less than we had in March 2020. But it's also at a similar scale to what we had back here in 2018. It's at a similar scale to what we had back here in June, July. And then again during this, in fact, you can see here this December 4th capitulation event that we had. This was this deleveraging that we spoke about back then. That was a very, very significant moment. You can see it's actually on par. In fact, this one's even more. This was 16 or 17%. In terms of 17% of the market suddenly found themselves at a loss. That was a lot of the top buyers that suddenly find themselves holding underwater positions. So even though we've had this kind of significant correction, we're starting to see across many, many metrics that it has been significant. And again, we're trying to assess why the sentiment is so bearish. And this is giving us a good reason. There's lots of people who have suddenly found themselves underwater, whereas barely, 1 month ago, they actually were above water. So it's kind of showing just how much accumulation happened in that zone. But now all those investors are actually back under that financial pain level. So we're just trying to map out why investor sentiment is the way it is. And we're starting to see a bit of a full picture based on all of these metrics. So now we're going to move into what was the response? How did the market actually react to all of this volatility? Now remember, we traded higher on the Wednesday and then traded much lower on the Thursday. So a very, very volatile close to the end of the week. And then we saw further weakness over the weekend. We haven't seen that recovery yet. So it makes sense that we're going to get some of that urgency coming in. Now, what we have here is two different metrics. These are mempool metrics. So these are actually looking at the flow of transactions. So on the left-hand side is the number of fees paid by all the coins flowing into the mempool. So people who are trying to get their transaction confirmed. And on the right-hand side is the number of transactions. Now, what we can see is a significant spike. Now, just bear in mind, we only started tracking this data at Glassnode back here in October. So we are limited to looking at it in this particular view. Just from that point onwards, there has obviously been more history. Bitcoin, the mempool's always been there, but we're just looking at the history from October onwards. And within that time frame, right, that captures the all-time high all the way down to our current position. You can see the significance of how many transactions, this was some 48,000 transactions, suddenly came in at the exact time that we were going through this volatile upwards, volatile downwards. So we can see that there was a degree of urgency. And note that a lot of these are in these red colors, these warmer colors. That shows that they paid a fairly high fee. The urgency for these people to get their transaction confirmed shows they could be de-risking, it could be selling, or it could be topping up their margin if they do happen to have leveraged positions on any of these exchanges. And we can see a corresponding spike in fees, which again is the largest in the history that we're tracking here. It was just over 3 BTC in fees suddenly flowed into the network. And again, you can see these warmer colors, which are high fee rates, really dominated. So the takeaway from this is that we've clearly got some urgency in people who wanted to get their transaction confirmed right then and there. And it kind of shows you an example of how you can use these metrics, these mempool metrics, to really identify when there's a period of financial stress and people are suddenly reacting to a new event, new piece of volatility, whatever it is. Now, we also have here exchange fee dominance. So we've got all of the on-chain transaction fees, how much of them are associated with, in pink, exchange deposits, in blue with exchange withdrawals, and the two green colors are in-house and inter-exchange transfers. Now, what's important is you can see this large spike here in the pink, which is deposits. So alongside this burst of transactions flowing into the mempool, there was this urgency of high fee rates. We also note that a large portion, in fact, this was the second highest exchange fee dominance in history. It's the same magnitude as it was of the 2017 peak. So we actually saw the same amount of kind of urgency to deposit coins into the exchange. The amount of fee expenditure going on deposits was actually equivalent to the peak of the 2017 bull run, which kind of shows the scale. In the bottom of a bear market right now, it's equivalent to what we saw in the bear back in 2017. And there's a couple of metrics that are similar to that. Now, the all-time high in exchange deposits was the May sell-off, which we've talked about a number of times. It really was this, amazing flush out of people. I think a lot of people were shocked and probably scared by that event, and that created an enormous inflow of overall deposits. So we've never actually revisited that level, but we are at the second highest amount of exchange deposit dominance. People that desperately wanted to get coins into an exchange, that happened over the course of this week. So here we are in exchange inflow and outflow. You may not have seen this kind of view before, but what I've essentially done here is put our exchange inflows in green, and then I've taken the negative of our exchange outflows and put them in red. Now in the middle here, you can see our net flow, which you may have looked at if you're using Glassnode Studio. That's here in black. But really what I want to highlight here is a couple of things. So the first one is that every single day, there are billions of dollars flowing both in and out of exchanges. So even at the lows here, back here at the end of July, you can see this was kind of the smallest on both sides. This was about $750 million in inflows and outflows. So it's about $1.5 billion. And that's kind of the smallest amount of inflow and outflow that we see these days. You can see that we had a very significant spike over the last couple of days. This is really, again, it's kind of supporting our exchange fee dominance. It's also supporting our mempool transactions. A lot of people deposited and withdrew for all sorts of reasons. Now, there was a bit of a bias towards inflows. There's about 1% more of the inflows, 1.6 billion in inflows, 1.55 in outflows during the sell-off. But the other thing I really want to highlight here is note the scale. You can see on the right-hand side of this chart, this is our kind of 2021 onwards cycle. Note how much larger it is. I mean, 2017 is quite small. This is the peak of all the exchange inflows as the 2018 bear set in. You can see that we are substantially larger. I mean, on our smallest days, we're kind of equivalent to where we are back in 2017. So it shows how much bigger the Bitcoin market is. We're talking billions of dollars in and out every single day. And just another point, this is also when you look at a chart like this and you see 1.5 billion flowing in on both sides, inflows and outflows, This is why we can use on-chain analytics to really track this buying and selling behavior, because people are moving funds all the time. And yes, there's certainly going to be coins and transaction activity and exchanges that flow into derivatives and, into different vehicles. But we still have an enormous amount of funds flowing in and out of exchanges every single day. So this kind of gives us that gauge on why we can actually use on-chain analytics for, at the very least, for some part of the problem that we're trying to solve. So now we're going to move in. So that's kind of the on-chain proportion. Now I actually want to go and shift and look at a few different angles, because we know that the Bitcoin market and the cryptocurrency market is a very dynamic beast. There's lots of moving parts. There's derivatives, there's on-chain, there's spot, there's ETFs, there's all sorts of complexity. And as an analyst, we really need to account for all these different elements all the time. So often when we see these big volatile moves, we tend to look towards the futures market to say, did we get some kind of liquidation event? Did we see a whole lot of leverage get flushed out of the system? Now, what I want to highlight here is that this is our futures open interest. So all futures contracts on the top left here. On the right-hand side, we have the daily change in open interest. Very big negative prints typically show open interest got closed out. It's a deleveraging, positions got forced closed. And the opposite is if you have high positive value, that's a lot of people opening contracts, actually creating more open interest in the system, which can sometimes lead to that deleveraging event. And down the bottom here, we have our liquidations, but we'll come back to that in a second. So the first thing I want to highlight, let's actually zoom in on our open interest just a little bit to see our current market structure. Now see this tiny little blip here? It's not actually that tiny. It's somewhere around $800 million worth of open interest. In the lead up to the Fed announcement, so actually in the days before, we saw this $800 million in open interest climb into the system. So people were kind of speculating, getting ready for it, which again would make you think that there's maybe a liquidation coming. And we can see that it got quite volatile over the last couple of days. Let's zoom in on a similar time frame on a one-day change. And you can see that we actually had a significant spike higher. About 30,000 BTC worth of open interest got created. Now, interestingly, before our sell-off actually happened, this actually reverted back down. A lot of that open interest actually closed during and just before the actual major sell-off that we had. And you can see this in our negative print just down here, about 25,000 BTC. So it was kind of an equal and opposite. A bunch of people opened contracts and then they got closed shortly after. But a lot of this was in the lead-in to the announcement. As the announcement actually happened, we had actually seen a lot of that open interest was more or less closed. Now, this is where we move across to our total futures liquidation. So what I've done is I've added together longs and shorts just to look at total liquidations. And you can see here, see this tiny little candle? This was about $135 million, which is a lot of money. But you can see that relative to previous history, it's actually not that significant. Now, as you can expect, there was liquidations biased towards the long side. That's what this red line here is showing. 62% of all the liquidations were longs. It does make sense when we get these large drawdowns. But the takeaway that I want you to have here is this doesn't look like one of these big vertical drops of $1 billion, $2 billion. It doesn't really stand out the same way as all of our other you can see these major liquidation events in March, here in July, here at September at the top, and then here in December 4th. It's big, but it's not significant. So yes, there's always going to be liquidations and futures open interest plays a part in it. But my real takeaway from this is that this particular move wasn't actually driven that heavily by a deleveraging event. It's not a liquidation driven event. It feels more like this is actually just poor sentiment. It's the market reacting to all the macroeconomic forces that are going on at the moment. So that's kind of a takeaway from this, is that it's sure, they play a part, but the derivatives didn't really drive this based on this data set and this analysis. Part of it, but not necessarily the driving part of it. A lot of this just is poor sentiment and reality of that. Now, very much alongside, we spoke about the accumulation at the beginning of this session. What I have here is the Canadian ETF holdings. So there's 3 different ETFs that we have, and I've used Workbench to combine them together into this aggregate up here in this pink. It's kind of all of the ETFs combined, and they tend to move because they're all competing with each other, but they all represent funds inside those Canadian ETFs. Now, the blue oscillator that we have here is kind of the 7-day change in overall coins held under those ETFs. So in total, did they increase their holdings, which is when we get these positive values? Or in the instance of this week, we've seen a significant decline. About 6,600 BTC have flowed out of these ETFs over the last 7 days. So alongside our softening accumulation pattern that we saw at the beginning, we also have softer ETF flows. So we've got now two pieces of information telling us that there has been a bit of softness across all of these accumulation metrics. So again, we can use these things to kind of back them up and form a bit of a cohesive story as to what's going on. And lastly, this is actually quite an important observation. So that's all Bitcoin. That's kind of looking at the derivatives markets, a lot of market structure type things. And our takeaway and our summary is that we do have a softer market at the moment. And a lot of it is being driven by this macro uncertainty, liquidity provisions, and tightening monetary policy. Now, what we also have, the stablecoin market is such a cornerstone. We've seen it explode from less than 5 billion back in March 2020 to over $161 billion, right? That's the all-time high, which we can see here in this red curve. This is aggregating Tether in green, USDC in blue, BUSD in yellow, and then DAI in pink. There are other stable coins, but these are the dominant ones that typically get most of the trading volume in our current market, and they're the ones that have been the most established for the longest period of time. Now, again, what we've basically seen is this explosive growth, right? Stablecoins have become the de facto trading pair for much of the crypto industry. We've seen a huge amount of the industry move their trading towards this stablecoin-based trading pairs rather than BTCs, what it used to be back in 2017 and before. Now, what you can see is there's kind of two different profiles here. Note that Tether has kind of continued to climb. We've seen generally climbing in BUSD. DAI has been a little bit flat. It did decline a little bit over the last couple of days. But look here at USDC. It's actually fallen by about $3.5 billion over the last month. So we've actually seen USDC being redeemed. People are taking that USDC and actually getting back raw fiat USD. So they're actually redeeming that. So we're starting to see this kind of decrease. You can actually see that this is so significant that the aggregate has plateaued and actually declined by some portion. Now, the chart on the right-hand side is that 30-day net position change. So the blue curve here is kind of showing the 30-day change. And you can see how significant it was through all of 2021, softened a lot after that May, June, July sell-off. But then we saw continuous overall growth in the supply. The stablecoins have, again, they've been a huge part of this industry's growth over the last 2 years. Now, the red curve is then showing how much of that blue is accountable by USDC, because USDC has seen a very, very significant amount of growth. Between it and Tether, they're the two leading. Tether's about 50-something%. USDC is about 30% of the overall stablecoin market. And you can see that particularly over the last kind of, let's say, 12 months, we've seen a very significant amount of that growth be driven by USDC. And note, here we are, we've actually seen our first redemptions in recent history. We have seen the stablecoin supply has declined. This is capital outflow from the industry. And again, it really backs up all of the metrics we've seen in this previous session that are showing we have a softer profile right now, and it's being driven by a lot of these tightening monetary conditions. And, we are in this environment where the traditional markets and the global financial system is having a much, much bigger correlation. Well, Bitcoin is more correlated to that market and many of the risks that are prevalent within it. So we're seeing this kind of overall desire for risk off. We're actually seeing people redeeming their USDC. USDC is the dominant one here. We're not seeing that yet across the other stable coins, but again, it's one of those other signs that's showing a real slowdown in this industry. And it kind of paints that picture that we just need to be prepared for any and all risks that may be coming, because we are seeing a softening across a great number of metrics. We have what I call what is called confluence, where many, many metrics are telling us a very similar story. And that's the time when you really do need to pay attention, because, there's a lot of bits of information telling the same thing. So to ignore that doesn't really make a lot of sense. So thanks as always for tuning in, folks. Hopefully that was useful, giving you a bit of a roadmap and seeing how you can spot confluence across multiple metrics. As Bitcoin and the market becomes more evolved and, changes and becomes more dynamic, we do need to take account of these multiple elements. We need to look at ETFs. We also need to look at stablecoins. We need to look at accumulation on-chain and derivatives. And you can see how this is both, it makes it complicated, but it's also a very interesting process, right? It makes the job as the analyst increasingly engaging and interesting. So hopefully that was useful. Hopefully you've kind of seen how these metrics fit together, and I will see you in the next one. Cheers.